Hey guys, this is Toby Mathis, and today we're going to talk about a tax-free crypto mining strategy. Now, right out the gate, I'm going to do this 10,000 foot view, and then I'm going to zero into a couple concepts. So number one, you got to understand the difference between the appreciation on cryptocurrency, and I'm going to use Bitcoin as the example today. So we're going to mine Bitcoin, and let's say that we mine Bitcoin and we mine it on a day when a Bitcoin is worth, let's just say whatever we mine is worth $100. And at some point, that $100, once you mine it, it is now going to appreciate from that point forward. The tax rules say that the act of mining is an active ordinary income. I am generating ordinary income at my own tax bracket if I am mining. So it may be, depending on what your tax bracket is, it's either going to be really, really low, medium, high, right? So if you're somebody who has a very good job or has other businesses where you have lots of income coming in, you may be paying as high as 37% federal income tax on that money of the mining income. Once it's mined, now we have our crypto coin. Now we have our cryptocurrency, and whatever it is, we'll just your crypto. And then we have the appreciation from that point forward. So let's say that I mine it at $100. So I'll just use this as an example. Let's say that we mine it at 100, and then it goes up and doing what crypto's been doing. Let's say it goes nutty and goes up to $1,000. So you have the mining of the 100, and this is ordinary. So that's ordinary income. That's at a regular tax bracket. You could be getting hit with not only the ordinary tax bracket, your federal tax bracket, but you could also be paying Social Security, which is old age, disability, and survivors, and Medicare, also known as self-employment tax. So the federal can be as high as 37%. The Social Security is 13 or 15.3%. So we get pretty high pretty quick. Half of that number is actually deductible, so it ends up being about 14%. So half your money is gone if you're a miner. So if I mine $100, I'm going to owe, in some cases, up to $50. I want you just to think about that. I'm not saying that that's going to be yours. That's as high as it could go, plus the state. So you could have somebody who's like, man, it's just not worth it to mine. Well, hang with me for a second, because I'll show you how to knock that puppy down. Then you have this portion, the $900. Depending on how long you have it before you sell, this would be called long-term capital gains. The way currency is taxed is it's ordinary when you mine it, and then you get capital gains treatment on any appreciation beyond that point. This is the point where we can absolutely make that tax-free. We can make it tax-free, we can make it tax-deferred, or you could just choose to pay the tax, depending on your structure. Today, I'm going to show you a tax-free way. And especially for those of you who are not in the highest tax brackets or who have Roth IRAs, I'll show you guys, or Roth 401ks. I'll show you guys how to do this, where it's going to be pretty stunning. And I'm just going to walk you through it. So number one, we have to have some sort of business. So let's say you're already a miner. So you're already mining. So let's just say we have a mining company. It could be a sole proprietorship. It could be a partnership. It could be a corporation, whatever it might be. S Corp, C Corp, doesn't matter. I can hang off of this a retirement plan. I prefer to use a 401k because I can be the trustee of that. I can be in full control of it. You'll understand why in a second, but it could be an IRA. It could be a SEP. It could be a Roth IRA. Like there's other things it could be. I prefer to use 401ks because I can be the trustee of it. When you have an IRA, there's a few things that we have to be aware of. You could never be the custodian of your own plan. You can be a self-directed, meaning that you get to decide what it's going to invest in, but you can't be the custodian. And it's really important on this next step, because as you'll see, we are going to take this and we are going to create another mining company inside of it. This is going to be an LLC, and it's going to be taxed as a C Corp for tax purposes. And the reason is this: we are going to be mining inside this entity. And since mining is an active business, if it was inside of a retirement plan, whether it be a 401k, whether it be an IRA, it doesn't matter. If it's in that retirement plan, it's subject to something called UBIT, unrelated business income tax. We don't want that. We want to isolate it by having the 401k set up the mining company. And if this is even better yet, this is a Roth 401k, then we will never pay any tax on any of the income that goes into that Roth as long as it's not UBIT. So we set up the separate company. Some of you guys have heard these terms. You'll hear checkbook IRA and stuff. This is what they're talking about. But when you're using a 401k for yourself, you could be your own trustee. You could do all this. You don't need to have a custodian and all those fees. It's like $300 a year to have a custodian. We could, boom, we're gone. We can ignore those. You're your own trustee. You set up the 401k, sets up the mining company. Now here's the secret sauce. You're going to have two wallets. You're going to have the wallet here, and you're going to have a wallet here. So when we mine, we're going to come up with, I'm going to use another color. Let's say we mine the $100, and it goes into that wallet. We are then going to transfer that to this wallet. So now we have basis of $100. And by the way, I'm being really simplistic. Those of you guys who are mining know that you get to take off the electricity and everything else. But what we're doing is we're taking whatever the coins are and we're moving them into the 401k. And if it's a dividend, so we're issuing the profit of the corporation to the 401k. Because it's tax exempt, there's zero taxes. So there's 0% tax. The generation of the income after the electricity, after all the expenses, that is going to be taxed at 21%. That's the only tax that'll ever be paid on any of this, and it's only on the mining income. Once you're done with the mining and you move those coins to that Roth, this is what's really cool. If this, remember we talked about the 100 going to 1,000. So now we have 100 going to 1,000. So we had $900 of gain. Oops, $900 a gain. 0% tax because it's Roth. You could take it out. At some, like when you retire, there's some other rules. If you want to take it out, I think it's after 5 years, we could take it out. But you can actually take the money out and never ever pay tax. What if this goes up to 10,000? What if you mine it, and after you mine this for a while, let's say that we generate, what does a card generate? Probably between 1,000 and 2,000 a year. So let's just say, I'm going to pick high. Let's just say that we have 3 cards. We generate $6,000 that starts into the Roth. And that $6,000 goes up, and at some point in the future, it's $60,000. How much tax do you pay on it? It's a trick. 0%. You'll only pay the money that you paid on generating that wallet, or generating the Bitcoin. So that's structure number one. If you do not have a mining company, you have no company to hang the 401k off of, then we're going to have to use something else. And what you're probably going to be using, it's actually kind of the same setup. I'll just kind of draw it out here. It's basically, is you would use a Roth IRA. And it's the same scenario, except we have to add a different step. Because it's an IRA, we need to get control of the business. So we're going to set up a checkbook LLC. and this one is disregarded for tax purposes. Now, you cannot go to LegalZoom or any of those places online and set these up. They have to be set up with specific language in where the manager cannot receive compensation. But we do it all the time, so we can help you. But let's say that you have a Roth IRA and it sets this up, and then this guy is going to set up, once you have control of this, because you can be the manager, you just can't be compensated or entitled to compensation. So those operating agreements become really critical. This guy then sets up the LLC for the mining company. And again, it's taxed as a C Corp. And remember before, we have a wallet here and a wallet here. Money goes up here. So again, if we generate $1,000 of profit, it's going to be taxed exactly $210 federal corporate tax. This money here, let's say we have $1,000 and it goes up to $100,000, your tax, a whopping 0%. That's why we like this. So you can go, you have to add this second layer. So the downside, I'll put a little downside. The downside is this one. That's going to add more expense and a little more complexity. If you have a business, you can hang your 401k off it. The other difference is this Roth IRA, I'm restricted on how much I can put in, like really restricted. If I have a 401k, I can actually put up to $58,000 a year into that Roth 401k. And before you go, no, you can't, Toby. Yes, you can. You have to do it in company distribution. It has to be a solo 401k that basically you control or allows contributions during the year from one side, the employee deferral portion, into the Roth bucket. So like whenever you set up a 401k, if this was a 401k, IRAs are pretty much plain vanilla. I could put like whatever, $7,000 a year into an IRA, whether it be Roth or other. So it's basically small amount. When you have a 401k, you have 3 buckets. These can equal $58,000 max during the year, but you have the employee deferral, and that's $19,500. If you're over 50, you can actually throw another, I think it's $6,500 that you can throw in there. You have the employer contribution, which is 25% of your compensation that can be put in. These are both can be tax deductible. And then you have the Roth. And this can be up to $19,500. Same thing. These two are about the same. That's the employee contributing. But here's the rub. I can over contribute to this up to my pay, up to $58,000, enroll it during the same tax year, because I never took a deduction for it, so I don't have to pay any tax. I can roll it into the Roth bucket. And that's what you could do with a solo 401k. I mean, technically you could do it with any, but it gets really complicated if you have a bunch of employees. So this is if you don't have employees, husband and wife or 2 partners doing a 401k, you can do a solo 401k. And then, boom, then we set up the structure. It's much easier, again, putting them side by side. The IRA needs to set up the checkbook LLC that then sets up the mining company versus the 401k just sets up the mining. Big questions, obviously, is what kind of wallet do I use? What kind of accounts do I open in these? You might use a Gemini's one that people use, Kraken. I believe Coinbase might be able to do it. I always forget which exact ones, but I know that Gemini does them for sure. And then you open up a wallet in each one. And as far as the mining, if you're already a miner, you know how to build these rigs. If you're not familiar, you may want to look at co-locating your mining equipment, just because the biggest expense with the mining is the actual equipment itself and then the electricity. And you want to make sure that your hash rates are low enough so that you're not burning up your video cards. And if I use the wrong terminology, I am not a miner. I know people that do it, but I don't mind, so I don't know all the terminology. I just know that you burn up your video cards if you're not using a monitor on the amount on your hash rate. The added expense here is why, and the limited amount that I can put in the IRAs is why I tend to be like, you could roll from an old 401k or even an old Roth 401k into an IRA, Roth IRA or a traditional IRA. When you use a traditional IRA, all you're doing is you're deferring the tax on that crypto. So again, let's say that I mine $1,000 worth of Bitcoin, put it into here, and that thousand goes up to, let's say it's 100,000. So I have $99,000 a gain. If it's Roth, I pay $0. If it's a regular traditional 401k or it's a traditional IRA, then it's going to be upon distribution. You're going to have minimum distributions at 72 that are going to be taxed at your ordinary rate, but you're not going to pay any tax on the crypto. Like if it sells, make 100,000, you don't pay any tax on that. If you have to take $4,000 out a year, which is about right, if you're going to when you retire, you'll pay it whatever your rate is then. It could be 0, it could be whatever. The average is less than 10 on retirement monies coming out, but you'd pay a little bit of tax later on. So kind of the side is, do I take a deduction now or do I take a deduction later? High income people, you may want to consider doing a traditional 401k because you get a deduction for it. People that are mid to lower income, you're probably going to be looking at the Roth component. So in either case, just showed you how you can do your crypto tax-free, with one little small exception, which is the mining. As that active income is generated, you're paying a small amount right now, and corporate tax is 21%. But the beautiful part about corporations is, depending on what you're doing in it, you're going to be buying more equipment. You could actually keep that pretty close to 0 if you finance some of this stuff and you know what you're doing on a tax angle. But that's a topic for a different day. You pretty much can get yourself down to that 0. Maximum is only on the basis of the crypto. You'd be paying a little bit of tax, but on all that appreciation, tax free, which we like. Hey, if you like this type of video or you know people that could benefit from it, please like and subscribe. If you know people that could benefit from it, share it as well. Go ahead and shoot that over to them. This is not rocket science. It's just creative planning so that you don't get walloped with that big old tax bill when you've been making some money in some crypto. We know that the miners work really hard and that they deal with a lot of adversity, especially in this day and age. You have a lot of places that don't like the Bitcoin because they want to keep control of that currency. In this particular case, you get huge rewards, but also you don't have to pay tax.